Here's a stock investing strategy that returned over 20% for the last 35 years. Let's see how great stocks plus cash flow equals money printing machine. Here's a quote from Bill Ackman. "We look for very high quality businesses, what we'd describe as simple, predictable, free cash flow generative, dominant businesses. A business Warren Buffett would describe as having a moat around it." So what can we learn from this quote? Well, following Bill Ackman's style, we want high-quality businesses with a moat that are also generating free cash flow. Now, we've seen examples of each piece of this in the past. For example, quality metrics. We saw how high ROIC stocks win over the long run. These were businesses with a high ROIC relative to the cost of capital. So as they grow, they create even more value. We also saw how to pick out compounder stocks, businesses that are better prepared to weather the financial storm. And we saw the fingerprint of a compounder by looking at the growth of invested capital over the long term compared with the changes in ROIC. And we found those businesses that maintained a high ROIC even as invested capital IC was growing. We also looked at a valuation metric, free cash flow yield. And so this yield was a comparison of the free cash flow we get out in exchange for the market cap or the share price that we're putting in. And so that valuation metric allows us to say, is this a good price to buy in terms of free cash flow? However, we want to avoid cases that are cheap for a reason. And so to do that, we can combine these two metrics, a valuation metric of free cash flow yield plus the quality metric of ROIC. So let's take a look at a quality cash machine strategy that combines these two metrics. So to test out our strategy, we'll use ValueGlance.com. Let's start by building out our stock screener. So we go to the stock screener tab and we add in market cap, ROIC, and free cash flow yield. So these are our three metrics. We want a market cap, let's say above 100 million, so it would be 0.1 billion, an ROIC above 20%, and a free cash flow yield above 10%. So that gives us our quality metric, ROIC, and our value metric, free cash flow yield. And we can take that to the maximum, and we could save this filter. Now we can go to the backtester feature and actually test this strategy over the last 35 years. So first we go to create new backtest. We can select our customized screener. We can select how do we want to rebalance, either annually or quarterly. And we can take the longest time period, we name it, and then we run our backtester. Now I've already ran this in advance, so we can go ahead and take a look at these results. So these are the results. We take a high ROIC strategy with high free cash flow yield. And we could see here in brown, this is the result of our strategy, the screener, over time, compared to the S&P 500 down here in blue. So clearly we crushed the market here because we're looking at it on the linear scale. We see the numbers here, 20.24% compound annual growth rate, CAGR. And so that strategy returns over 20%. $1 we see grows into over $630 over this 35-year time period. Really good. What about the market, the S&P? So we see the S&P returned 8.5%. And so over that same time period, it turned $1 into about $17. Now, if we want to better visualize this, we can go to the log scale. So remember, on a log scale, a straight line corresponds to exponential growth. But the advantage here is that we can see the whole past much more clearly. On a linear scale, because of the exponential nature, things that happened in the past look very small and we get this hockey stick curve. But when we go to the log curve, we can see things more clearly. And so we see the ups and downs of the S&P 500. We could see the tech bubble in there, the housing bubble. But then we also see our strategy here, which was just compounding away and crushing it. So on the right, we can see a pie chart of the different companies that we're holding. And we could see that breakdown over time. But what matters to us is that we maintain a relatively diversified portfolio here. You could see 30 stocks each quarter. And we're getting this great return compounded. And so this is the test. This is the test of time. We can see through wars, pandemics, booms, bust, bear markets, bull markets, all of the ups and downs, 35 years of real historical data in the stock market that a strategy with these simple metrics, combining the quality and free cash flow yield, can beat the market. And we're getting here over double the market's rate of compounding. Right, so 20% when you compound that, again, $1 into over $600 over that 35-year compounding period. So hopefully this illustrates the power of combining these two metrics for high-quality businesses that can maintain that moat, again, following that Bill Ackman quote, at the same time as generating strong free cash flow and a free cash flow yield that's high relative to the share price you're paying. So high-quality businesses bought at a reasonable price using free cash flow, and we get a money printing strategy. So if you want to test your own strategy on real historical stock market data, go to valueglance.com. You can try this out, build your own screener, backtest your own strategy. If you sign up for our free Substack newsletter, you'll get a code in there for 50% off ValueGlance for your first month. So please check that out. If you want to learn about a high quality stock investing strategy, you could check out my book, Stop Checking the Price. It's available on Amazon. And with that, I wish you the best of luck finding high quality stocks that are printing money for the long run.